Hello and welcome to Switzer Investing. I'm Paul Rickard filling in for Peter Switzer. Well, the rally continues. Another update in the market today, all coming ahead of an important Reserve Bank board meeting tomorrow. Will rates go up by 0.5% or 0.75%? Well, we'll find out at 2:30 p.m. Eastern Standard Time. But to tell us what he thinks and also to share his thoughts on some tech stocks that he's watching, my first guest is Dawes from Shaw & Partners. Raymond Chan will be joining me also to talk about a couple of healthcare stocks, while in particular he likes these leading healthcare companies and thinks on a relative basis they're a reasonably attractive buying. And finally, Peter caught up with James Haslam. He's the CFO of a particular favourite of ours, that's ELMO Software, involved in the HR software processing or software as a service business. And he shares his thoughts on ELMO's preliminary results. That's what we've got in store for you. Stick around on Switzer Investing. One of the big movements over the last couple of weeks has been some of our technology companies. Joining me now to discuss that and also what's in line for the market this week is Dawes from Shaw & Partners. Adam, welcome to the program.
Yes, thank you. It's great to be here.
Reserve Bank meets tomorrow. I guess the market's expecting 0.5%. Is the risk still that we might get a supersized cut and they might go increase and they might go 0.75%?
Yeah, it's definitely a risk, and it's definitely something that I think the market is probably buying into a little bit here. I mean, we've had such a good run over the last week of July, so it's great that we start into August, on a real positive note. But I do think that the market is a little bit concerned that if it is a 75 basis point rise, that potentially, the market might take that as a little bit of a negative going forward. But overall, I'm really impressed with the way that the market has taken on board these rate rises, and it looks like they're now starting to get used to inflation and getting used to higher wages and potentially getting back on its feet, which is great to see.
I know we've been sort of following the lead from the US in this regard, but is this sort of the classic sort of bear trap? What do you think? Or is it just, reporting season obviously in the US has gone okay, and I guess that's pretty important for our market, but it's been a pretty good rally over the last couple of weeks, hasn't it?
Yeah, it has. And you're right, it's that bear market rally that you've got to be worried about or concerned about. So I haven't been putting too much money into this last rally, albeit the tech stocks are looking pretty good, and we'll talk about that a little bit later. But certainly you're right, it does smell of a bear market rally where potentially we might retest those lows again going forward. So yeah, I'm a little bit cautious of this rally. And the problem is that it's sort of death by 1,000 cuts on the way down, and then all of a sudden it starts to bounce, and you say, "Oh, it can't be the rally to end all rallies." Something's got to go wrong. So I think overall it is looking that we are waiting for this week, certainly for the RBA. We've got more quarterlies coming out, which is really sort of giving us a bit more colour, and then reporting season, which is only a couple of weeks away.
Just run me through the key quarterlies this week coming up.
So I don't know some of the major ones. I know we had United Malt Group today come out with quite a disappointing one. We've also seen a couple of other companies sort of coming out with half decent ones as well. But there is a long list of those ones, and I think looking for that, was it Super Thursday, which is about 28 companies reporting around that sort of 26th to 28th of August, is going to be the big one where we try and digest all of the information.
Yeah, there's certainly a lot coming in that last couple of days of August, so Super Thursday. I think even a few have moved into the Friday, which is normally companies try to avoid a Friday reporting day, but there's quite a few lined up on the following Friday, so it's a busy time of year. Let's go to tech stocks, because they've, particularly the US, had a really good rally, and we had a big rally in the latter part of last week, which is sort of faded, maybe a huge short covering rally, but let's go to a couple of stocks, because I think at one stage Zip went from, it was sitting there below 50 cents. I think last Friday we hit almost $1.60 or something, maybe a bit higher. Now it's back at about $1.10, $1.11. Just bear market rally, short covering rally. How do you sort of read what's been going on with some of the tech stocks?
So we've done some analysis on Zip as well as some of the other tech stocks, but namely in the buy now, pay later space, trying to get a grapple on what's actually going on here. Because really that rally that we saw was, it came from the quarterly, but it was pretty much unprecedented as far and how quickly these things did rise. And then you're right, starting to fall again as well. And we thought it was short covering as well. So we thought that was the natural explanation on why this stock has started to move. And I'm just talking about Zip here. But we did some work on that, and the shorts are actually the same amount they were last week and 2 weeks and 3 weeks ago. So we're actually thinking it's not short covering. We then actually went in to look at who's the biggest trader of the stock, and lo and behold, it's CommSec. So what we're actually seeing is that we're actually seeing that this rally has been driven by the retail market,
right,
as well as then been pulled back by the retail market. Now, a lot of institutions, obviously, they're potentially shorting Zip at the moment, but Zip's now come down to a market cap that's actually smaller than potentially what people or institutions would like to go in and buy at. So it's actually not a lot of institutions moving this around. It's actually the retail money, which is the biggest surprise to us going forward into Zip, because that short position has not changed.
So does that mean, often that's often seen as a bit of a negative when just retail gets into a stock, but sometimes institutions follow. So, Zip was once a $12 stock, got down to below 50 cents. It looks like it's listed in the market in the sense that it's cut back at its cost, it's got rid of some non-core businesses, really focused now back on Australia and to a lesser extent the US. It seems to have done what the market's asking of it, but that doesn't give you confidence, or do you think it really needs some institutions now to come on board to take this, if this is going to be sustained?
I agree. Institutions definitely need to come in, and that over that dollar mark is probably a great sort of level where potentially the stock will travel or sit for a little bit. Look, I think Zip's absolutely doing everything right going forward as far as then cost cutting, non-core assets, getting exactly like you said. So I think they're doing all of the right things. They potentially will need to raise some more capital soon. So I think that's potentially where institutions might be waiting for them to, come through and make a play. But yeah, institutions and retail need to be working together to get that moving and to get that share price moving. So, a lot of institutions or sophisticated investors follow momentum and follow volume, and there's certainly been momentum and volume in that stock. So that should start ringing or putting some alarm bells on some people's computer screens to have a further look into the business as it moves around.
So Zip's not necessarily on your buy list at the moment, if I read what you're saying correctly, is that?
Officially, Shaw and Partners has a buy on it. I've got a lot of clients that are in at higher prices. I'm just holding back at the moment. I want to see how this rally trades. I think $1 is probably where it's going to sit for a while, so we've got some time. So at the moment, I'm cautious, but I wouldn't be putting any fresh money in. Happy to hold it for clients at the moment, but no fresh money.
Okay, let's go to another one that's been hasn't had quite the same volatility, but it's been a favourite of a lot of investors, and that's Megaport. Last week again, sort of hit a high on Friday. It's probably come off about 15% since Friday, but not quite the same volatility that Zip's had. That's all in the past had a lot more institutional support. So what's your take on Megaport?
Yeah, Megaport we really like. We've got it in a lot of clients' portfolios, and we're buying. We bought some more today on this little bit of a pullback. I really like the business, so happy to continue to keep buying Megaport. Megaport's one of those ones that has a fantastic thematic around it, and has just been really caught up in this sort of tech sell-off that's going on at the moment. I think the stock's up 53% or something like that some ridiculous number for the month. So it's had a good run. Probably due for a little bit of a pullback, but really like Megaport. I'm happy to keep buying that one, and we expect that to continue to go higher from here.
That's definitely on your radar then. Okay, and then another one that's been with a lot of clients is EML payments. It's been pretty troubled, a lot of problems with the regulator. We've had the change of CEOs. It's now back. It's getting back down towards its lows again. Had a good rally last week, but it's come off from the high. So first of all,
Yeah.
take on what's been going on with the new CEO being appointed. You kind of get its problems in Europe with the Irish central bank sorted. What do you think about EML payments?
Yeah, it's probably one that I put in the too hard basket. I did have some clients in at higher prices. We got out. I think it's just for me, it's just a little bit too hard. There's too many headwinds that are going now. The new CEO coming in, absolutely, he's got a really big job ahead to get that right and to make sure that this business is going to move forward. But really, at the end of the day, I think there's too much water under the bridge, and the market isn't confident that these guys can actually make do with what they've got.
Yeah.
These guys have tried so many times. Ireland now has come back and said, we've still got some issues with it. We're going to get it sorted. But for me, there's too much uncertainty there, too many things that can go wrong, and it would be an avoid from me until all of these issues are sorted out, and then you can feel safe to be investing in the business, and they've got some clear blue sky also.
So that's really a buy, hold, and I won't say a sell, it's an avoid from you, but EML's the avoid, the buy is Megaport, and the hold is Zip Payments.
Well, there you go. You wrapped it up all in one show. That's fantastic.
Let's just go to a couple of the leaders. I might just do the two market leaders in Xero, and if you want to give us your views on Xero and also potentially WiseTech. Let's start with Xero, Adam. I know this is a little off notice, but I mean that seems to have found a bit of a base. It's bounced nicely.
Yeah, it looks really good, doesn't it? And I think the market's somewhat getting excited about it. It's not up as much as Zip or EML, but I think that, not as much as Zip or Megaport. But look, I think it's one of those ones that it's a bit of a slower mover as well. Really happy with Xero to keep buying it under $100. I think it was around that 96, 97 mark. It looks like the confidence is now starting to come back into the stock. The tech side of things is starting to look pretty good. So yeah, comfortable with a buy on Xero. And
they've got a price increase, I think, that comes into effect on the 1st of September. So any of the Xero users out there, you'll find your bills are going up. So it gives you something about also their market power now in terms of once they get clients in. It's very hard to, or very few want to move. So it does give you an idea about their pricing power. And the other one is WiseTech, which I guess is now almost a sector leader. It really hasn't fallen far at all. It's bounced back. Any views on WiseTech? It's had obviously tailwinds in terms of what's been going on in that whole industry with logistics and transport and so forth. But what's your view on WiseTech?
Well, WiseTech is obviously in an upgrade cycle because we saw the earnings being upgraded just the other day. So that's a fantastic, fantastic result for WiseTech, and it's probably one of the first ones in the tech space to have an upgrade in earnings, which has now allowed potentially the rest of the tech sector to have a bit of a breather, and potentially people now starting to look at it again. So really comfortable with WiseTech. Overall, I think it's a great business. They've done really, really well in getting that business and tying it up and moving forward through COVID, all of these kinds of things. But, you know, WiseTech has done well. So it's a comfortable buy for WiseTech on me. You always buy companies with earnings upgrade cycles, and I think that fits squarely within what WiseTech is talking to the market about.
Well, that's a wrap for WiseTech, Xero, and not Zip, sorry, but Megaport. So thanks for that wrap. 3 buys, 1 sell, and 1 hold. So that's a good way to summarise it. That was Adam Dawes from Shaw & Partners. Joining me now is Raymond Chan. Raymond's the head of the Asian desk at Morgans. Raymond, welcome to the program.
Hi Paul, how are you?
Now let's talk about healthcare. It's been one of the relatively weaker performing sectors, but did a lot better in July. And I think you see that as continuing to be one of the better performing sectors going forward. Is that right?
Yeah, Paul, I find it pretty interesting. Like if we look back the past 20 years, in fact, the healthcare sector outperformed the market 80% of the time, X0. However, what we are seeing is with COVID, we saw initial outperformance of healthcare stocks at the beginning of COVID. Then it's pretty much underperformed for especially for FY22. And it's only lately that we start to see some life on the healthcare sector. So that suddenly, in terms of sector, that there's a few key themes happening at the moment. I guess the first thing is we note the sharp rally in US dollars up until pretty much 2 weeks ago. That certainly assists the US dollars earning, because when we talk about the healthcare company, the biggest healthcare company on ASX are pretty much global player.
Yeah.
And it's interesting, 20 years ago, when I look at healthcare sector, it's like below 5% index weighting. And today, when I look at it, it's a bit over 10%. So certainly, I think it deserves a portfolio weighting in client for client. The key point we have to look at is, despite the recent small rally in the healthcare sector, we start to see a bit of life. Does it warrant that we have a meaningful position in the healthcare sector? And my answer to that is yes. I think the healthcare stocks, in the past been doing well, and I think in the future they will continue to do well.
Okay, now over the longer term, they've been great performers, and they've had a lot of sort of, I guess, tailwinds from the aging population, plus just the increasing demand for healthcare services, plus a lot of government support, which obviously helps in a global sense. But it's often been seen as a very expensive sector, particularly in the Australian sector, compared to, say, how healthcare is viewed in the United States. You've got an interesting graph on so-called price earnings multiples. Do you want to just go through that and talk about the relative cheapness or not of the sector?
Absolutely. It's interesting to note with the healthcare sector, because of the defensive of its earnings. The market in Australia happy to pay relatively high PE. In fact, the sector PE average around a bit over 30 times. However, back in 2020, so a bit, over 2 years ago, the PE actually traded up to 42 times.
Wow. Yeah.
And the beauty about the last year underperformance is that actually brought the PE back more to ground. So I think now they are trading the sector PE now back down to around 33 times. With the biggest stocks like CSL, I think they are on about 31 times forward PE. Now it's become more reasonable. So I'm not too worried about the sector being on a 20-30 times PE, because this is what the history been telling us, and I think the sector continue to be very defensive in terms of its earnings.
Okay, well, let's go to your sort of preferred stocks, the preferred picks in the healthcare sector. Number one, I understand, is ResMed.
Yeah, ResMed. I think it's an interesting choice because the viewer will probably question, hey, ResMed just have its very soft third quarter earnings. As a result of that, the share price on ResMed has gone down, and then lately it's bounced back from its low. We think what happened is, the sale of the medical device being very slow during the COVID period. Now the economy has become more normalized. We think the sales will bounce back. And also what gives us the confidence is one of CSL major competitor, Philips, they are still going through a recall process. So that's going to contribute to more market share gain for ResMed. And ResMed will have the all-important fourth quarter result coming out on the 11th next week. So we will be able to see whether they can recover from a bit of hiccups in the third quarter. For now, I think we have confidence they will be doing okay in the fourth quarter, given the competitor recall.
And now ResMed's primary listing is in the US, so that's why you get the fourth quarter report. But look, just one of the other things, ResMed's been diversifying into software as a service, in addition to sort of its traditional sort of sleep apnea type devices. How do you think that's going?
I think that's going really, really well. And this is, one of the very few healthcare company in Australia. They actually get into the technology space, make use of the big data and the like. And this is something that we like for the future of ResMed. And I think they certainly spend the money and time in the right area. And I think that will result in a competitive advantage being developed over long term. That's why we think the weakness in ResMed, despite already recover a bit from the low, continue to be looking favorable going into the reporting season.
Okay, let's talk about your other preferred stock, my favourite stock, which is CSL. Has been struggling to get back through $300. I've been waiting for it to get there for, I guess, a lot of investors for some months. What are you expecting in CSL, particularly? I think it's due to report on the 17th of August.
Exactly. So the key about CSL will be how well they collect the plasma. Certainly, last year been a difficult time. Over the past 2 years, been a difficult time for CSL to collect the plasma, which of course is an important ingredient to develop their drugs, to manufacture their drugs. And even CSL will have to fight with the government to allow the Mexican to cross the border and donate plasma in US.
Right.
Unlike Australia, we do blood donation, but in America they actually pay money to accept the blood the plasma donation. The one report suggests that the plasma collection has now back to normal. In fact, one report suggests it's actually back to pre-COVID level. And if I look at one of the result of another pharmaceutical company last week in US, they are also focused on the plasma. The demand is very strong for the product. So that gives us a bit of confidence that CSL is going to have a better outlook statement, and which I think is important, whether that can, push CSL back to, the $200 mark. So CSL, remain comfortable, and for clients who don't really look for the yield, they look more for the long-term growth. I think CSL appear to be well positioned to do so.
Do we expect any news about CSL's acquisition of Vifor Pharma, which of course is the big chronic kidney, treatment or manufacturer? I mean, how's that acquisition progressing?
Our analysts think, this is likely to be a long-term integration because, this is the area that they are traditionally not deal with. So this is more like a new income stream for them. We think there will be some update. However, we don't think there will be meaningful in terms of what they are going to report this time.
Okay. Well, let's hope you're right, Raymond, because one of the things about CSL, one of the reasons I really like it, is it has a habit of under-promising and over-delivering. It's surprising on the upside with results announcements. It has provided pretty tight guidance, so I guess we're looking for it to be the upper end of that guidance, but let's hope we get it. The market gets a positive surprise on the 17th of August, and we'll note down both ResMed and CSL as your preferred picks in the sector.
Thank you.
That was Raymond Chan, the head of the Asian desk at Morgans.
All right, well, joining us now is James Haslam, the CFO of ELMO Software. Reported well this week, and the market liked what they heard. But it's a company that struggled. It's a tech company. It's obviously in the small business and medium-sized business space. Let's find out what's happening to the company now and what needs to do to impress those sons of you-know-whats that make up the stock market. James, good to talk to you.
Likewise, Peter. Good to be here.
I'm sure you and your CEO, Danny Lessam, at times, you do look at the stock market and think, those sons of you-know-what. No comment is a fair answer to that one, James. All right, let's not be too hard on something which is a necessary evil. Let's talk about, so this week, I think you're up at, Leah, this week your share price is up about 15%. which in a week when you report is a good sign. It means that the market must have liked what they've read. What do you think were the standout features of this report?
Oh, Peter, I think it was incredibly strong results. Real high growth in our annual recurring revenue. So that's really the value of our customer base that as we look out to the next year for $108 million, and that grew at 29%. So really showing the strength, and that's supported by new customers coming on board and existing customers being upsold to as companies move to increase their digital footprint with their HR software, having automation built in. So we're really seeing that strength. We call it the tailwinds. We've seen that coming through in spades, and that 29% growth. And second to that, and of equal importance, is we're now at a scale where we're starting to see operating leverage really come through, and the cash burn really start to come down. So the cash burn on a monthly basis came in at just around 1.4 million per month, down from 2.2 million in the financial year 21. So that improvement, those jaws, as we call them, are opening, and we're on that pathway to break even. So we also provided our guidance alongside our result as well. So we provided that quite early, and to give the market some idea as where we see the next 12 months playing out. And I think those three things combined have gone down incredibly well.
Okay, and so you've forecasted that you'd break even in financial year 2023 or calendar year?
Financial year. So we expect to break even but for the 30 June 23 year, we expect to have an operating cash flow break even.
Okay, where is your revenue was up, what, 32%? Is that right?
Correct, yes. Yeah.
Where is the revenue growth coming from? You mentioned that existing customers are up buying the modules you sell, but you're also saying new customers. Are new customers coming in the medium-sized business segment or in the small business segment?
Across both, Peter. We've seen the 29% growth in the mid-market, and we define that as being from customers from 50 up to 2,000, and also the small business segment in our what we call the Breathe brand in the 50 and below. So we're seeing, and that was at 34%. So we're seeing in both segments, we're seeing new customers come on board, but we're also seeing that new existing customers take in more as well. So we're seeing that growth in both segments, but also in both geographies as well, with strong growth coming out of the UK, which we invested in FY21. Has
your position in the UK been affected by the economy over there? They've had a few struggles, haven't they? They struggles with COVID. They've got very high inflation rates. I don't think their growth is spectacular, though you can correct me if I'm wrong there. But putting it all together, it hasn't been what you might call a gangbusters boom economy in the UK.
I think we've experienced something quite different on our side. Not putting those things to side, but with our solution, the expense management solution, we've seen a lot of strength come through with customers continuing to utilize expenses and start spending. And on the small business side, we've really seen new customers coming on board. Those small companies really need to still adopt, to support remote-based and hybrid workforces. So we're seeing a lot of adoption in that small business space. So that's a lot of strength coming through there, irrespective of that macro drop back. And we're expecting that to continue on. So yes, we've seen inflation in the UK market, and that's also features as part of our pricing as well. So with inflation, we also have some increase on our pricing there. But we're actually seeing a high rate of adoption come through small businesses, and see mid-market also show resilience there. So we've actually grown quite well in that market over the last 12 months, and we do expect that will continue through next year. I think the easy way to think of our product is it replaces in terms of cost side, it's more efficient spend than hiring more people into the company. So we look at that as our typical customer size is $27,000 to $30,000 a year of licenses, and that may avoid you hiring someone between $80,000 and $100,000 a year. So we help bring that automation in to the companies.
Okay, I know in the past Danny thought that the work from home trend was going to advantage your business. Explain why he would think that, and do you think that message has actually got out to your potential customer base as well as you would like?
Very much so. The remote-based and hybrid working looks like it's here to stay. I think it's a pivot in most companies who can adopt it, and we are seeing the move into that environment, and that's where our solution helps fill the gap, because historically things like financial products, like a Xero, etc., accounting system, people have been able to do that, manage their finances remotely and through the cloud. And human capital management is that next thing that people now need to manage their employees and work with them on their hybrid. It might be recruiting, doing online recruitment or onboarding, payroll as well. So we're seeing things like that really come through and be popular with customers. And that's creating a large pipeline of future customers, because a lot of mid-market and small businesses don't have a solution around their HR needs. No. They may have a financial solution or customer or CRM, but not a HR solution. And so that's why we see it's a great greenfield opportunity, not just in the Australian, New Zealand market, but also in the UK market as well, where we invested when we bought the Web Expenses and Breathe businesses in FY21.
Are you getting your fastest growth for Breathe in the UK, where it's been there for a longer period? Yes,
the vast majority of that growth is based in Breathe in the UK. So the small business product in Australia is still very much in its infancy, but in the UK, that's all the growth and the revenues are already coming from there.
Yeah. Have you learnt anything about the marketing of the Breathe product in the UK that's going to help you sell it here? Because, to be honest, I have a pretty big handle on what goes on in the small business sector. And apart from seeing that wonderful sign outside your building on George Street as you drive up, and that shows the confidence you must have in the product, I haven't seen any marketing grabbing me as a small business owner. And I really do think small business owners need to have an IR solution for their business. But they don't know they know they need it, but they're probably paying other people doing it, like bookkeepers or their accountants, or they might even have an HR person helping them. It seems to me it is the sleeper that could really make a big difference for your business.
Yeah, certainly, Peter. I think in that medium longer term, we'll see a lot of growth coming out that small business product. And at the moment, we're certainly growing it healthily in the UK, and I expect it will really get going here over the next couple of years. So it's definitely a focus to really build out the awareness of the small business and penetrate that small business community, because I completely agree. I think this is something that these small businesses need. It's a heavily automated product. It's very easy to use, and absolutely ramping up marketing efforts to make sure that we get the message out there and start bringing the customers on board. I mean, it's a very economical, low cost solution for companies to have, and it really does help them out with their needs.
Does it also help them avoid making mistakes with their employees that could get them into some trouble with, the commission or whatever, Fair Work Commission, because you actually are doing it right rather than doing it wrong?
Look, it certainly helps with accuracy and of your records and keeping data. I can't comment on around fair work issues, but really it's around the employers using the information, using the effectively the database and reporting that comes with that. So it certainly enhances their ability and improves the accuracy. Okay,
so because you're a numbers man, I'm going to ask you this question. What does it cost a small business person to sign up and get the benefits of Breathe?
So the average customer, if I look at the UK market, average customer is $1,000 a year, and that will scale up. It depends on different price bands depending on how many employees you have. So it starts off at a very low price and it moves up depending on your branding, and typically services customers from 5 employees up to 50 employees. So we actually have our pricing all published on the website for any small businesses that want to look. It's very standardized.
Yeah, but given the fact that it's going to be a tax-deductible expense, we're not talking about a huge outlay to actually nail a lot of your industrial relations or HR issues.
Yeah, correct. So this very much very cost-effective product to really help manage your people.
Okay. What are you guys going to do between now and next reporting season in just after Feb, or in February, I guess, for you guys? What are you going to do to excite the market about the potential of your company? Because that's what your shareholders want you to do. Excite the market and get the market buying your stock and pushing up the share price.
Look, I think we're in an incredibly exciting 12 months in the evolution of the ELMO group. So we expect to continue to deliver high levels of growth. We put our guidance out at 24 to 29% ARR growth over the year, and also that move towards cash flow break even. So from my point of view, it's continued to deliver what we've been doing. If you look to the last 5 quarters, we've got a very good handle on the cost base. We're seeing the growth coming through, and we're really pushing that pathway to break even. So really by getting through to the next reporting period at December and then into June next year, provided we deliver on these numbers that we're put out in guidance, I think that should really really help the market and investors.
Okay.
Really focus on that shareholder return.
Okay. Well, I think you're making the right decisions when it comes to the AFL supporting the Swans, but don't know about your decision to support Manly Warringah. Anyway, that's up for your marketing department. James, thanks for joining us.
Peter, a pleasure to be here. Thank you very much.
Thanks for joining us on Switzer Investing. For more insights, head to our website at switzerreport.com.au.